Hi, this is Stuart Weems, and thanks for listening to the Investopoly podcast. My goal is to give you simple, easy to understand insights, strategies and tips to help you master the game of building wealth. In this episode, I'd like to talk about share investing because frankly, most people aren't very good at it. 19 out of 20 times I see returns are ordinary at best. When I meet clients that have managed their own share portfolio, they typically have a portfolio of 20 or less stocks, so not a lot of diversification. Most of the stocks are either in a loss or profit position, but marginal. They're just sort of break even. And if they are in front, which is rare, most of their profits are sitting in only one or two different stocks. So they've just been lucky to some degree in terms of timing or just random luck that they've made some money. So there's four mistakes that I think investors make when investing in shares. The first one is there's a total absence of methodology. So they don't have a methodology in which they're going to invest in the share market. It tends to be very random and ad hoc. I read this research report, I like this stock, so forth, but they don't really have an idea around asset allocation, how they're going to beat the market, and whether they take a value approach or a growth approach, or whether they just want to go index and so forth. They don't think about it, and they make decisions on the fly from year to year. I might add it to the portfolio, I might sell it. Number two, they believe they can make a quick profit. Howard Schultz, who built Starbucks, says that short-term success does not create long-term value for anyone. And that's very true in lots of things, but particularly in the stock market. So share investors typically think too short a term. Warren Buffett says his favourite holding period is forever. Don't buy a stock unless you're prepared to hold it for 10 years. So take a very long-term view because you are rewarded, which is a great segue into mistake number 3, which is no patience. Again, another Warren Buffett quote is that the stock market has a very efficient way of transferring wealth from the impatient to the patient. If you had purchased $10,000 worth of CBA shares when they floated for $5.40 in 1991, your investment would be worth over $150,000 today. Now, you have to ride out the bubbles and the market corrections and the bull markets and the bear markets and so forth, but you find a really good stock with a really good business model with a really good profitability and you hold it. Now, I'm not advocating investing in direct shares, by the way. I'm going to get to that in a second. But the point is that just make an investment decision and stick with it. Have the discipline to stick with it. And mistake number 4, which I think is by far the biggest mistake of all, that probably is responsible for most of the losses, is a complete absence of of diversification. So, as I said, most investors I see have 20 or less stocks. It's just not enough to diversify unsystematic risk. Unsystematic risk is company-specific risk. And in fact, a lot of the research around active versus passive methodologies, a lot of the benefit of going index is just the mere fact that you get a lot of diversification. And no one knows and no one can pick which stock is going to perform best. So it's like picking a needle in a haystack. And as Bernard Melke says, just invest in the haystack, which is the index. So diversification plays a very, very big role in share investing. That is undeniable. So what can you do? Well, you need to. There's probably 3 things you can do to negate some of these mistakes. Firstly, you need to adopt a proven methodology. I think you need to start doing a bit of research around direct share investing, stock picking, active funds management, and passive and index management. And if you have a look at the growing body of evidence, significant evidence, it shows that indexing is a far better way to invest. You need to then, secondly, take a long-term view. Think about an asset allocation and a methodology that you're willing to stick with for the next 10 or 20 years and then stick with it. Don't get spooked and so forth. Just stick with a tried and tested evidence-based investing methodology. And number 3, diversify. Diversify in terms of markets and asset classes. If you're going to invest in shares, that's okay, but think about bonds because you need to balance out the portfolio's volatility. Bonds typically have 2 to 3 times less volatility than shares. Shares have a significant amount of volatility, so you need to think about that and whether you're comfortable with going all shares, but then certainly diversify markets. The US market, for example, a lot bigger. Australia's sort of 2% of the global economy. It's a dot in the ocean. So, you really want to have exposure to international and US stocks, and then also Aussie stocks. And you can do that through exchange-traded funds, through low-cost index funds. So you can get broad-based exposure to a lot of those markets. There you have it. That's how to win at the share investing game. Until next time, bye for now.